All right, let's dive right in. Today, we're unpacking a really fascinating real estate puzzle. We've got two of North America's heavy hitter cities, Toronto and Austin, and on the surface, things just don't add up. The story here goes way, way deeper than just interest rates, so let's get into it. So, right off the bat, here's the central question, the big paradox we're tackling today. It seems completely backwards, right? You'd think that cheaper money, lower interest rates, would automatically make a city a better place to invest. But as we're about to see, the market is telling us a totally different story. And this slide just lays it out perfectly. Look at this. Over in Toronto, you've got these lower interest rates, but the property valuations are what we call sticky. They're just not budging. Now compare that to Austin, higher interest rates, and yet valuations are actually getting better. So what gives? Well, to figure this out, you have to look at the cap rate, which is basically your yearly return on a property. The real story is hidden in those numbers. See, the answer isn't really about monetary policy. It's about two huge, powerful forces simmering under the surface, how easily people can move around and whether they can actually afford to live in a city. These are the hidden drivers that are really shaping how investors feel. This brings us to a really important idea for Toronto, structural friction. The best way to think about it is like sand in the gears of the economy. So even with the helpful push of low interest rates, Toronto is kind of stuck. It's being held back by a housing supply that can't keep up, prices that are just off the charts compared to what people earn, and real roadblocks that make it tough for workers to actually move there. And here's what that friction does to investors. This quote just nails it. They're pricing in a growth discount. What that means is they're looking at Toronto and saying, hey, it doesn't matter how cheap money is. If companies can't hire people, and if those people have nowhere affordable to live, then my investment just can't grow. That is the affordability trap in a nutshell. Okay, so now let's flip over to Austin and see the total opposite. The key phrase here is growth fluidity. This is an economy that's running smoothly. It's an environment where not just money, but more importantly, people can move around easily. You've got high mobility between states, a housing supply that can actually grow to meet demand, and a business-friendly vibe that just fuels a powerful engine for growth. And if you're wondering what that frictionless environment actually looks like, here's a perfect example. Things like Texas being a right-to-work state and having no state income tax, that's a huge magnet for both companies and for workers. It just creates this deep pool of labor that helps sectors like logistics absolutely boom. So, we've got the theory down, right? It's friction versus fluidity. But how does this actually look in the real world, on the ground? Let's do a quick fire round and see how this plays out across 4 key real estate sectors. First up, offices. Now, look at those cap rates. Austin's is way higher. But here's the twist. Investors don't see that as a sign of risk. They see it as excess yield. Basically, they feel like they're being paid a nice premium to get in on a market where huge tech companies are expanding and fueling real, tangible growth, which is something that affordability trap in Toronto makes a whole lot harder. Okay, let's jump to the industrial sector. In Toronto, the cap rates are actually going up, which is not a good sign. And a big reason for that is labor shortages. The crazy thing is, it's not that there's a lack of people, it's the struggle to get those people to where the jobs actually are. Meanwhile, Austin's frictionless labor market can easily support the massive logistics boom. And what about retail? Well, this one's pretty simple. Toronto's growth is capped because its customer base just isn't expanding that fast. Austin, on the other hand, has this constant wave of people moving in. That means more families, more people, and more spending, all of which is great news for retail real estate. And finally, let's look at multifamily housing, apartments. Even with a super tight supply in Toronto, investors see a hard ceiling on how high rents can possibly go. Why? Because people are already stretched to their absolute financial limit. In Austin, even with a ton of new building, the high mobility of renters and a steady stream of new arrivals just soaks up that supply and keeps demand strong. So the current picture seems pretty clear, but what could totally flip the script? Well, the future of these markets isn't written in stone. There are some huge policy decisions, potential game changers that could radically alter everything. Let's break it down. For Toronto, the bull case, the best case scenario would be a massive policy U-turn on housing. Imagine if they got rid of development charges or passed aggressive fourplex everywhere zoning. That could completely shatter that affordability ceiling. For Austin, the big risk is external, a trade war. Slap on some heavy tariffs and that could seriously damage its status as a mobility magnet, making that growth premium just vanish. And just to put a real number on Toronto's potential upside, if those policy changes actually happened, the analysis shows that cap rates could compress by a whopping 40 to 60 basis points. That's a huge shift in valuations, and it's all tied to whether they can unlock the city's growth. So here's the bottom line. For a certain kind of investor, Toronto's tough situation right now, it actually looks like an opportunity. This quote says it all. You're buying into a market at a discount, but you get what's called embedded optionality. It's almost like getting a free lottery ticket. If the policies change for the better, you could be looking at a massive payday. Okay, so let's tie all of this analysis together into a simple, actionable playbook. Based on everything we've just talked about, there are really 3 different ways you could play this Toronto versus Austin showdown. First, you've got the value investor. They're looking at Toronto, seeing those higher yields and that policy lottery ticket, and they're making a bet on a long-term turnaround. Then there's the growth investor. They're happy to accept a lower return up front in Austin because they're betting on that powerful, nonstop growth story. And finally, you have the risk manager. They don't try to predict the future. They just buy both, balancing Toronto's issues with Austin's incredible momentum. And really, that brings us to the final question you have to ask yourself. In a way, Toronto is offering a premium for a certain kind of safety, one that's built on constraints. Austin, on the other hand, is offering a premium for pure growth. So, in the economy we're in today, which one of those premiums are you willing to pay for?